You're listening to another episode of the Fredericksburg Strong podcast. This is a local forum to inform and entertain our community, discuss local news, promote small businesses, and celebrate our hometown heroes with a little dose of humor to keep you entertained. Our mission is simple: to keep Fredericksburg strong. Today's podcast is powered by Pohanka Nissan and Pohanka Hyundai of Fredericksburg. And now, here's your host, Tim Pohanka.
Hello everybody, it's Tim Pohanka. I am doing another Fredericksburg Strong episode. This time we're here to talk about insurance, and I've got Bryce Reeves with me. Thank you for joining us.
I wouldn't miss it.
I do appreciate you doing it. We're friends. We go back a long ways. And this is probably one of the things that, I don't think people really get insurance. So you're a State Farm rep.
Yep.
But you're not really a rep. You're a business owner.
Yeah. No, I'm a State Farm independent agent. So we're captured by State Farm. I don't sell like Allstate or any other products. I'm not an independent, but I'm if you want to call it a franchise for all sake of purposes. But yeah, I have to make payroll and put away estimated quarterly taxes and last one to get paid and those sort of things. So yeah, it's a small business and been doing it 16 years now, I think 17 years now.
So because of that, it's really about the service you provide. It's not just about when you think about insurance, you're protecting yourself against a potential problem, but you do get customer service in it. I mean, you can go online and buy insurance,
sure,
but then you miss all of that.
Well, I call that value-added service, right?
Yeah.
Same thing you get at Pohanka. If you come in, is your car washed, or do they go the next step and make sure it's vacuumed and put in the paper protection and all the other things, right? If you value your car, you guys go that extra thing. It's the same thing for insurance. Unlike Warren Buffett, I believe, especially when you're dealing with insurance, and we do banking, insurance, investments, healthcare, health products, long-term care, all those sort of things. So there's a value-added service to that, right? And insurance is one of those things, you pay for it, and some people think it's like a warranty, which we all know it's not a warranty. It's for the what-ifs, right? Mm-hmm. Just in case, kind of hedging your bet. But when that time comes in, you do have a claim. Do you want to just talk to 10 different people via telephone, or would you like to go see somebody who understands you, knows your family? As a State Farm agent, I know, probably 95% of my customers personally, right? And take that extra step to get to really know them. So as their families grow, as, a new child comes into the house and maybe it's a new driver, what does that mean? What do your insurance rates look like? What are the risk factors? What do you guys need to add coverage-wise for that new driver? What's their liability exposure if they were to go out and kill somebody in an auto accident, right? Or postman slips on their front steps. What do they do? And that postman says he's going to sue them personally. Do they have coverage for that to make sure they don't lose everything they've worked for their whole lives because of a lawsuit, right? And we're in a very litigious society today. And, you see the commercials run by attorneys all day long. Hey, right? And so how do you set yourself up financially? And I always tell people, I'm kind of here in the dream business, right? I'm here to help you kind of realize your dreams and protect you from the unexpected, right? So, from coming in, not just, State Farm used to be auto, life, fire, health. Well, we've kind of, after the Glass-Steagall Act was passed under the Clinton administration in '98, banks could become insurance companies could become banks, and so all that stuff went away. It used to be if you wanted insurance, you had to go to an insurance agent. You want a bank, you had to go to a bank. You want all the other stock, investment products, you had to go see a broker. All that kind of switched. So now we're kind of under one roof where you can buy and get it all. And so not only has our education skill level and licensing requirements expanded, that of our staff and everything else to understand the products and services that we provide under the State Farm umbrella has really grown. So it's challenging, and when you have a regulatory environment that is constantly trying to update and interpret congressional laws that are passed and these sort of things, and in those mandates. And prior to starting the podcast, you and I had a long, lengthy discussion about COVID and some of those things, how they affect business. And so we're affected by that because we're a highly regulated industry, right? We have an insurance commissioner in Virginia. We can't just arbitrarily set the rates on people's insurance. Those are managed. We have to ask for rate increases based on, actuarial data, all these sort of things. And so, but there are also a lot of outside factors that contribute to the rise and the fall of how agents like myself, independent agents with State Farm, or a contractual agent with State Farm, how we get paid and how we make money. So.
When you take it to the basics for anyone just going in, the first thing that most people think that they need is car insurance.
Right.
In Virginia, you can have full coverage insurance, you can have liability only, and then then the part that gets me, you've got all the different limits and things that go on there.
Right.
So when you're starting out with car insurance and you're looking at it, the liability only, that just covers the
you
car.
go out and hit somebody.
That's
you
it.
go out and hit somebody, it's going to protect you from losing your shirt, right?
Up to a certain amount.
Correct.
But then when you start looking at all the other ads that you can go into it to get full coverage, that's when you start picking up.
Well, in that term full coverage, that's kind of a misnomer, right?
Okay.
What is full coverage? Full coverage for you is different than it might be for a new driver, right? Because you're successful. You own a car dealership. You have a lot of employees. You have a lot of assets that you have to cover if something were to happen to you as the CEO of Pohanka, right? Mm-hmm. You're Tim Pohanka. You go down, the ship goes down. So how do you cover that? So my thing would tell you that, yes, that is true. There's basic liability limits. And in my second hat I wear as a legislator, there is talk about bringing up that minimum liability from 25, 50, 25 when you look at your coverages to, higher, 100, 300, 100 as far as, dollar amounts. Because, look, today's cars, a used car is worth more than $25,000.
Correct.
Right? And so, I'll give you a case in point. Last November, I'm rear-ended on I-95 at about 80 miles an hour. I was part of a 3-car accident. I was the front, and the poor car behind me got crunched. Well, the guy that caused the accident was texting while driving, and the good news is he was caught on video because somebody had a driver's cam. The bad news is he had basic coverage, right? So the car that hit me was first in line. By the time it got to me, I had nothing, but I had my own insurance, so I had to go through my own insurance company, State Farm, of course, and they subrogated against his company, which was Allstate, right?
Uh-huh.
And Allstate's going to cover that individual up to a certain point, and they're like, hey, we're off because we're only covering you because this is what the coverage you had. So then, in order to get whole again, I have to sue the guy that caused the accident. Well, if he doesn't have any assets, I'm getting nothing. Right? And so how do I get whole again? And that's where State Farm makes sure I'm whole, and then they'll subrogate against that individual.
So really, it is interesting you should say that about the minimum coverages, because that's one thing that we always talk about with leases. Right. Manufacturers require a higher coverage amount.
Sure.
And that confuses people. And, I did not even put that into my thought process that now the value of cars have gone up so much. And $25,000 doesn't cover anything.
Especially on a lease. You don't own that car. You're basically renting on a long-term note, right? Mm-hmm. With a contractual guarantee that I'm not going to go over a certain amount of miles, and if I do, I got to pay a certain amount for each mile that I'm over when I get ready to turn it in. So basically, you're renting a car for 3 years or whatever. The bank owns that, right? They're going to require you, because that's an asset to them, even though it's a depreciating asset, that they still need, it has value. So they're going to protect their assets. So that's why they're asking you to have higher limits on a leased vehicle, is because the bank owns it and they have a vested interest, right?
If they're in that 3-car accident, they own the vehicle. They're still at risk. They're still at risk.
Right.
It's interesting you bring that up. I mean, again, back to the value of cars. The average transactional price for a car now is around $24,000.
Right.
And if the limit's at $25,000.
You're done.
Yeah, I mean, they're not going to. You have to fix 2 cars.
It's over.
It's over.
Right. No, I mean, you're not replacing a bumper on the car for less than $1,000.
Yeah,
now,
yeah,
right?
exactly.
So,
and then you look at deductibles. How does that play into it? Here for our dealership, we have a $2,500 deductible for anything that happens for a dealership car. Are people going with the lower dedeductibles, or do you try to steer them in the way of going, hey, listen, it may be a lower deductible, which is great. But
here's when you talk about insurance rates, there's a multitude of factors that go into where a company gets its pricing models, and we call them tiers. And we used to only have like 3. Now I can't even tell you all the factors that go into how you're rated individually to get in a certain pool of risk, right? You know, and let me just explain it to the folks that are watching and listening how insurance works. Insurance is like a big gambling house in some sense, right?
Yeah.
They're highly regulated risk company that says, hey, we're going to try to figure out what kind of driver Tim Pohanka is. So we're going to run these reports. We're going to look at his driving record. We're going to look at his claims experience. How many accidents has he had since he got his license at 16? You know, what's the frequency of them? How long apart were they? All these certain things are, how fast was he going? Was he struck, or did he cause the accident? All these different things, right? And then we're going to come up with where we're going to put you and how much we're going to charge you based on your risk to the company of having another one, right? And we're going to try to somehow actuarially figure out what the rate is we're going to charge you. And so, you know, insurance companies look at all those factors: frequency, your credit score, are you married? You know, if supposedly you get married, you calm down some over age 25, right? There's certain all these different factors that they've figured out. And so when you get that policy and you start going forward, they're going to look at all the other things on that thing. They're going to look at the crash rating on the car, right? Certain cars, if you have one of those Dodge that has the big Hemis in it, and
the more powerful the
more
engine,
powerful, you're going to pay more money because the probabilities that you're going to wrap that thing around a tree are probably greater, right? All those things are all factors into your rate. You take that, and then what I would tell your first drivers is that are listening that want to do that, and you talked about deductibles, is insurance companies themselves are saying, hey, wait a minute. Even in homeowners now, you won't see the $500 or $1,000 deductible for a homeowner's claim now, right? Because what you have to understand is that insurance isn't designed theoretically for a maintenance policy, right? And the same goes for cars, right? You all sell in the business today extended warranties on your products. You can purchase those separate of the manufacturer's warranty, right? And you can do that through your finance guys. Mm-hmm. And that gives peace of mind to those people that, hey, at 46,000 miles, because most manufacturer warranties, except for like Hyundai has a 100,000 mile drivetrain, those sort of things. Whatever's not covered under those warranties. You know that for me to pull it in the shop and replace a transmission on a newer car is $1,500 just for the part, and then you add the labor, which is another $1,500. You're down $3,000. Whereas I can get an extended warranty somewhere in there. I'm just doing quick math. For probably about $1,700, I can extend that warranty out to 100,000 miles in 5 years versus 3 years, 36, somewhere in there.
Yep.
And you look at when typically people, you can do the homework, and when people have problems with a certain vehicle, what those cost. Risk versus reward. Is it worth paying the money up front to get that extra assurance? Insurance works the same way. Whereas yours is a warranty, this is peace of mind, right? Am I risk adverse? What's my risk tolerance? So and it depends on also your ability to be able to afford that.
Oh, well, then that which is
right.
Affordability that comes up is, what is that affordability for you? Right,
and that's what people have to look at. I'll give you an example of a client I had at one time. Guy, day laborer, brick mason, young family. They had one car in the family, just kind of starting out, everything else. Well, that one car got both parents to their jobs, right? And they really wanted to try to get some other financial products started, but their risk factor was too high. If that car broke down or got in an accident, what do? So my thing was, look, we need to give you the right insurance coverage. You don't have to have the max, because they didn't have a lot of assets if something were to happen. But I needed to make sure they had collision insurance on that car so they could have a rental car, right? So if they got in an accident, they still had a way to get to work because they're at the basic level and they're just they got to go to work. if they can't get to work, they don't have any money to pay their bills anyway, right? So I've seen that family progress from the very start to now they have other products, life insurance. They have a 401k or a Roth retirement account. We help them set that up. They had the 529 plan for their young girls who are now older and getting close to getting ready to go to college, so they can help with that. And we're not talking a ton of money. It's $50 a month for them, but they're putting that money away because they've set themselves up to be financially secure. When they first started out, they didn't have that ability because nobody sat down with them and talked to them about financial literacy. What's important and what's the risk? What do you have to lose and what do you have to gain? And that's every family, every person is different. And it's not just, here it is, here's the block, here's what you need. Because what will happen is some people will go, well, just give me the cheapest. But they don't understand when you say, I need whatever the minimum is. That's all I want to pay. I want the lowest price. Well, when you get the lowest price, you're also probably getting the lowest cut rate insurance. Are they going to be there financially solvent for you if you were to have an accident or an incident? Are you comfortable with that? Are you, does somebody actually sit down and talk to you about that? When I sit down with some of my policyholders and we start talking about products other than just insurance, we talk about what are your long-term goals financially. And I break kind of money down into three categories. There's now money, which is the money you need to pay bills, to pay rent, pay utilities, all that stuff. Later money, which is money that hopefully you're putting towards retirement someday. You're not going to work your whole life till you're in the grave. And then what I call never money, which is to the next generation. Like, what do you want to leave behind for your kids? Mm-hmm. And I view money in those three categories. And then based on those three categories, then we talk about what products are out there to help you get to that end where you have never money that's going to be passed on to the next generation. And there are just all these different things that kind of get in the way of that, estate tax and all these other things. And how do you look at that and how do you protect that nest egg that you worked 40 years doing? How do you protect that? And so that's the part I really like about my job. Basic insurance stuff is basic insurance, but most people really aren't that financially literate to really understand what that means.
So you brought up financial literacy, and I'm going to come back to that.
Okay.
Because I think that's a really important topic. We've touched on that before with other guests. But going back to State Farm and what you do, and you mentioned the risk and how they're judged, and credit,
sure,
driving record. They're talking about these new apps. There's things that they'll plug in the car to tell you how fast you're going,
right,
and what that. I'm going to have you put your legislator hat on too.
Okay. So
let's say you go and you get that little dongle and you put it inside your car. It's tracking everything you're driving.
Sure.
How often does that report? Does it generate a monthly report that says, "Hey, you speed, so your rates are gonna be higher"? Or
no, it's about a discount.
Okay.
Right. Your rate is going to be the same. You drive better, you're going to get a better rate. It'll come down. It's not going to necessarily go up if you're driving over 80 on 95 and everybody else is going 90 and you're trying to just stay below reckless, right? So what it does do though is it allows State Farm to keep you honest, right? We used to say, well, how many miles a year do you drive, Tim?
Uh-huh. Yeah,
right?
which is
right?
And everyone's going to tell you, oh, I drive like nuts.
Right, 12,000.
Where's the garage?
Right.
Yeah, where's the garage?
Right,
it's garage.
exactly.
Yeah, I keep it there. Yeah.
Right.
Yeah.
And so now, we still have clients and policyholders do that, but now they see that, hey, it's financially worth it to me to put that device in the window so you can track those driving behaviors and understand that. And if you're a good driver, you're going to save money on your insurance. If you are not a good driver and you don't want, to get those extra discounts, you don't have to do it. Nothing's requiring you to do it, right? It's an option to you, right? It's not a mandated thing. The legislature hasn't come down and said everybody, insurance companies, to keep everybody honest. But it does help the insurance company, right? They're going to know exactly how many miles you're putting on that car so they can make it rate adequate.
So I think I started thinking of that. I saw that and I thought from a parent standpoint, I'm like going, well, wait a second. Does this mean I would get a report on what my child's doing driving my car?
Well,
20% of the time you're going over the speed limit. Or,
you'll be able to see it.
Yeah.
They have those devices out there now. I have it's not i360, it's called 360 Life or something
Yeah.
like that, where I can see when my son's driving and how fast, and it lets me know that, hey, you went over here, and I like that, right? But I don't necessarily want that on me.
No, of
Right?
course. It's I want to be the reviewer. I don't want to be the review.
Right.
No, of
Exactly,
course.
right? But
So,
hey, you're
are
a young driver, you're accountable.
So have you seen that? Have you seen that adoption on that product on a lot of people's cars?
Yeah, there are. And
Have you noticed this? Are we seeing a sharp reduction in
Premiums?
How people are driving?
Yeah, I think you have, and I think, but it's almost like cameras. This room is filled with cameras, but as we converse, I don't think about cameras. So people, I think, after a while, just forget they're there, right? And so you're going to get their natural driving behavior, right? And how they drive. Are they a cautious driver? Are they not a cautious driver? And those sort of things. And I think we're tracked by so many things. Like I don't understand it all because I'm not a computer guy all that much. But we might talk about cars, and the next thing I know, I'm gonna open my phone up and I'm gonna see a Pohanka ad coming on my ad.
Well,
right?
we're following you anyway. But that's okay.
Exactly. That's what I'm saying. So
No, it's funny you should say that. I don't know what I made mention of the other day, and then the ad showed up on my phone. And I'm like going, I know Apple and and Alexa and all. I know they're listening. Which, neither here nor there. But I'm putting your legislator hat back on.
Okay.
So I've got this dongle, this thing in my car. Is that being used could that be used in a court of law?
Well, I'm not an attorney, but I would say anything is subpoenable based on my law enforcement days. Whether or not they could suppress it, but yeah, they use the black box out of cars when they're in crashes, right?
And that's actually, it's funny to say that's a huge issue for us because they come in, hey, we want this. You've got to.
Well, if you got a search warrant and a subpoena, you got to give it up.
Yeah.
Right. So it just depends on who's prosecuting the case or anything
Who's
else.
asking. Yeah.
But look at the litigation that you had from Alexa, right?
Oh yeah.
The murder's happening, and Alexa picked up the conversation, and they convicted the person of conspiracy to commit murder. You hear about all this stuff all the time, right? So I think that's where technology has exceeded the law, and until some of these cases go through the system, and there's some rulings and everything else, which will help set case law up, I think you're going to have some of that. But my first instinct would be, yeah, they probably would. If they knew that was happening. It's just like cameras that are out there. If you're working a robbery of some place and the store across the way has a camera that's focused on the parking lot, they're going to go over and subpoena that owner for that footage of that camera to see if they can catch the criminals, right? So I would think in that scenario,
Yeah. So you bring it back to financial literacy,
okay,
which I think is really probably the most important thing you brought up when you look at long term. Because it's not just about your car insurance.
Right.
The one insurance that I've seen that I never would have thought about and how important it is long-term care insurance.
Oh, absolutely.
And we're in a society this society where who's going to take care of me down the road. When you start to look at these products that you have that you can put together, how would you rank the importance of each one?
Well, I would tell you, I'd love to. Person come in and have enough assets that they could have a little bit of everything because you can fully protect them, right? It's like having that egg, and then how much bubble wrap can you put around that egg?
Yes.
Same thing. So when you talk about long-term care, for folks who are listening and watching, you have to understand what long-term care really is, right? And how it works within the Medicare system, which is over age 65, and that's the health insurance for those folks over age 65. And then Medicaid system, which are for folks who are basically indigent, and that's less than, I think it's $5,000 or $6,000 of assets available to their name, and then the government picks up that check, right? But long-term care itself is designed to take care of a person who can't do 2 out of what they call 6 activities of daily living, like feed and bathe yourself, or those sort of 6 activities. If you can't do 2 of them, then you're going to need somebody to come in and help. That's what we're talking about. And a lot of our older folks who've maybe had a stroke and those sort of things, hopefully they get better, but most of the time in a lot of situations they don't, but it doesn't mean they died right away. It just means somebody's going to have to care for those people until they pass or they get better.
And
right?
you have to, a lot of people are hoping their family will do that.
Correct.
And a lot of families, people can't.
Correct.
When you start to look at what you have in your daily lives, I mean, we all.
Well, I look at couples.
Yeah.
Look at a married couple, right? I'll give you an example. My dad and my mom. My mom passed away about 5 years ago, and luckily, she went quickly, right? However, my dad, a few years earlier, had a hernia that went bad, and he became septic. And his pathway back to recovery was 9 months. And my mom wasn't in any shape to take care of him. But luckily, their son's a State Farm agent. They had long-term care. So that policy kicked in, so they weren't having to spend their own money to put him in a care facility. The policy kicked in and paid that. And then when Dad got better, he got all the money and the premium back that they had paid out for that policy, because the nature of the policy that we had with State Farm did that. Gave premium back to them because he did get better. He didn't just go into a nursing home or assisted living facility to, full-time care and then pass away. He got better.
Because a lot lets you stay at home.
Correct.
It's home care first before you start going.
It depends.
To
You can use the benefit however you want if you have your own individual policy outside of some group policies and some of those other things. So that's what we sell with State Farm, is a individual long-term care policy, and then you can put all kinds of like inflation riders on there, and you have what's called a maximum daily benefit. You can set it at 150 to whatever you think that amount is that you think you're going to need to bring somebody in to pay them for skilled nursing care or whatever that is. If that's somebody to help you eat and somebody cook for you, but you're self-sustaining on everything else, you don't have any cognitive impairment, any of that stuff. So it just depends on how skilled that nursing is to come in. So it's critical, because otherwise, if you take a husband and wife, that spouse is not going to let their spouse do without, right? They're just not going to do it. They're going to start dwindling down their savings to nothing, to where they literally have no assets left, to where so this is where setting up some trust and some financial instruments is very, very important, right? And there's a way to do this. But so let's say Dad, usually the men are the first ones to go in a long-term marriage. Mom has been paying all this stuff. She's got down to nothing, and Dad passes away. She's got nothing left. What happens when Mom's health changes? Because everyone's health is going to change eventually, right?
Yeah.
Right. We're not all lucky just to go like that. So what does she do? So typically what happens, she has no assets left. She's going to go on Medicaid. And usually there's 10 beds per every big facility, and whether or not they have a Medicaid bed there, and if they go to the hospital and come back, is that bed still going to be there? So how do you juggle those things? So that's why long-term care is so important, and especially when you look at the boomers and where that aging population, our parents are, right?
Well, when you look at the advances, the advances in keeping people alive.
Of course, we're living longer.
Right? When you just look at that, in some cases we're, and I don't want to sound crass, but we're keeping people alive longer, but we're not necessarily getting them back to a healthy state.
And their quality of life is not the greatest.
And that's the part that, yes, it's great that we're able to extend life, but there's those other costs and those other things that go along with it.
And down to the kids and their kids, right? And if you're trying to pass on what I call that never money, then you probably should have a long-term care policy in there as part of your kind of financial portfolio, along with your life insurance, right? Because if you're at that point near the end, you want to make sure you have enough life insurance to cover those expenses that whoever you're leaving behind can cover, so you're not leaving them with a burden as well. It's not always, just enough to pay funeral expenses, but how do you want the people you're leaving behind, how do you want their quality of life to continue when you're not there, right? And depending on where you are in that phase, sometimes when you get to the end, you might want a policy just to pay taxes. If you've been very, very successful in your life and you have a lot of assets, over $1.5 million worth of assets, well, I think that's where the number's set. Maybe it's 3.5, I can't remember. But the government's going to tax a portion of that estate tax coming down, right? The death tax that you hear about. Well, how do you protect yourself with that? Right now, life insurance is still non-taxable, so you can take some of that life insurance and pay the estate tax, so the assets will flow through. So it's setting up financial instruments to do that.
So going back to financial literacy and understanding how your insurance works,
Right.
the other part you brought up, which is interesting, is slipping and falling.
Sure.
You know, I worked at pools growing up, and we always talked about assumed risk. If you go to a pool,
Right.
it's going to be a wet deck. There's an assumption that you could slip and fall. But someone coming to your house, whether you have a dog, whether you've got a loose step, your homeowner's policy protects a certain amount.
Correct.
But does it cover those items that some of those things that can occur?
It'll have what's called MedPay on your policy. You should have MedPay. If you don't have MedPay, you want to check that. You also want to make sure on a homeowner's policy that you have backups of sewers and drains. I know different companies don't even have that, offer that. So if your sump pump backs up and the rain's coming, which some companies won't let you add it right now with the rain we're about to get here, right? So people that are watching this are like, yeah, our basement floods all the time, right?
It's funny you should mention that, because I actually have FEMA flood insurance.
Right. Well, you're in a flood zone.
Because I have a sump pump.
Right.
And and they told me my insurance wouldn't cover if the house flooded. I'm like, oh my gosh.
So you must be in the actual flood plain.
In Lee's Hills. So
right.
Yeah.
And so, but I tell people you want to check and make sure, because what'll happen is you'll get, depending on the company you're with, you're going to get a notice, a renewal notice that you got to pay. But in that renewal notice, it's going to tell you all your coverages. And that's why I think it's important to have an agent that understands, goes, well, wait a minute, has anybody sat down with you and done an insurance financial checkup with you lately? Kind of like going to get your car tuned up and new, oil change and all that stuff. You got to do that every so often. Because if you're not paying attention and for some reason when you first put the policy on, you didn't have that and then you have a big claim, you're going to be mad.
Oh, yeah.
Like you would have thought you were covered, full coverage, but you didn't have that rider on that policy. So you want to check to make sure you have that rider on the policy. Now, slip and fall, what I would tell you is we sell a product called a personal liability umbrella policy. It's a PLUP policy, right? That covers you for liability on your cars, in and above the liability limits on your policy, as well as that on your homeowners. So we call it an umbrella policy, right? So it'll pick up either one of those. So Joe Postman comes over and you didn't shovel the stoop because you were tired and you were selling cars all night till 2 a.m. trying to make your numbers for the end of the year. You're like, it's no, it'll be okay. Well, he comes down, he falls flat on his back and he gets a little cut on him. You're like, hey, I love you, Joe. Get in the car. I got a 4x4. We're going to go to the hospital. We'll pay up to $5,000 of your medical costs right there to get you stitches and all that stuff. Joe's like, that's great because I don't want to use my insurance. Company pays that. Then Joe finds his attorney later and says, you still having problems? We're going to sue him, right? So Joe sues you for $150,000, but your homeowner's policy liability only covers $100,000. What do you do, right? Where do you get the extra $50,000? Well, that's where the PLUP would come in and kick in and cover you for it.
So people really do need to take a look at a lot of what goes
Oh, yeah.
on, because it's not, you mentioned the sewer, the sewer. When I first my first 2 houses didn't have a sump pump. I'm like, I don't know what this thing is. It's a hole
Right.
in the ground and water comes out of it.
Right.
I thought I was a water company for a while. But you start to look at all of these different things, or items that you buy in your house.
Right.
I started buying some art. Well, I need to get a different policy to cover the expensive
All your
things.
contents, right?
Yeah, because you've got content insurance,
Correct.
but you don't have content insurance. You want to make sure that the important things are
And you
covered.
can list some of those. You can buy riders that would list if you're a watch collector
Yeah.
or gun collector or art collector. What is that worth? Because you have to think of worst case. Your house burns down. How much would it cost you, Tim, to replace everything in your house? And some of it might be irreplaceable, such as workers of art that, doesn't have to be a Van Gogh or anything, but it could be
One and
an
done.
up and coming,
Yeah.
right? And how do you replace that? And one thing I tell people too is, now with digital media and everything can go to the cloud and everything else, go in your house and just take pictures of your closet, right? Because after a critical incident, are you going to remember everything that's in your closet?
Or have receipts for everything.
Well, and that's the other part of it, right? How do we validate, if I'm the insurance company, how do I validate you really owned it? Are you just saying it was there? Because that's a pile of black mush. that's
Yeah,
wet and
it
soaking.
looks like plastic. I don't know if that was a flat screen TV. It could have been, yeah.
Right, you see what I'm saying? But if you have at least pictures of your house, of the inside, of everything that's kind of there, then that gives you a digital record of the inventory of your house. Because that's what you need to think about. We get a Class 5 hurricane come through, and some of these tornadoes, like we've gotten some microbursts that have come through here and takes off a corner of a house and half the bedroom's gone and the closet. I mean, think of clothes. Think of all the clothes you have and individual shirts that you've bought and all those suits and ties, and how much is all that really worth to get back? Now, some people are like, I'd like to get rid of half that stuff.
Oh, yeah. You're like, oh, wow, this is great.
Yeah, clean it out. I got to get in the closet. But the other part of it is, what does it really cost to replace those items? And that's what you need to look at.
So, you brought up hurricanes and floods, and, we've seen the terrible wildfires that are happening out west. Are houses here covered in that type of instant where is that an act of God?
Yeah. So lightning strikes, wind, hurricanes, it's all going to be explained in that real fine print on what's covered and what's not covered, right? Tree falls on the house, usually and it's your tree or your neighbor's tree, it's going to be covered because it hit property on the house. Tree just falls in the yard, didn't hit any quote property, dwelling or anything, not covered, right? And you have a certain amount of liability yourself. In other words, if you have a dead tree out there, you probably need to take care of it. Just like if you had a tree come down on your roof and it punched a hole in the roof, the insurance companies say you have an obligation to get somebody or you yourself get a tarp if you can do it to keep from more property damage happening, right? So
Cars have that. If
Right.
if you don't turn your car off when the check engine light comes on.
Correct.
Yeah.
Yeah. So you assume some of that liability by the nature of owning the house, right? So it just depends on, every claim's a little bit different. Backup of sewers and drains. I've seen us pay claims where like a G.I. Joe or Barbie's been flushed down the toilet by somebody who came to visit. Well, you didn't know it, and it backed up in the house. It was covered, right? It wasn't the homeowner's fault. It was an accident, right? That stuff happens. That's why you have insurance, right?
So one of the other things that people always talk about is fear of being canceled because they have a claim. If I'm with State Farm and I have a claim, does that immediately mean that State Farm's going to cancel me tomorrow?
No, but there are companies that, they don't have accident forgiveness or anything else. And what they'll do is they'll look at, what you have with State Farm. What's your frequency? What's the claim amount? Are there a bunch of, like 10 small claims just over the deductible amount? And so that's why it's important to discuss, because they do look at frequency. If you have so many claims, it's a matter of time before you have a big claim, right?
Mm-hmm.
So insurance companies going, not a good bet for us. But if you've been with State Farm for 40 years and you maybe had one claim when you first got with State Farm way back when, and then, here you are 40 years later and, your homeowner's deductible is, 2% of whatever that amount is, $2,500 or whatever, and you have a $10,000 tree damage claim, they're not going to counsel you, right? Now that experience will, later on, if you had 5 more after that, then they're going to look at it and go, the frequency doesn't fit, right? Based on the longevity of the time you've had, right? It could just be bad luck, but they're going to look at that. They're not going to automatically drop you.
So when you also look at the other thing that goes in, and is people who are super high risk, they have to get high risk insurance.
SR22s, right?
Yeah. And a lot of those deal with whether it's drunk driving or some other things that go into that. Is that something that State Farm has as well, or is that something?
We don't write SR22s.
Okay.
So we're not in the high risk pool market. That's not our business model. We're very conservative company. Been around a very long time. We'll be around way past you and I are gone, right? It's not one of these internet-based companies. It's just here, and they're superficially lowering their rates because they want to build their base. What we found up with State Farm is there's a balance, right, of claims experience versus, gathering a lot of new business. It's unproven, right? We found that claims go up when you got a lot of new business that isn't kind of tested out there. And so there's a balance that happens there that the company looks at actuarially. After Andrew, I remember State Farm was the only solvent homeowners company in Florida left, right? Everybody else had to go belly up. They couldn't pay their notes, right? They couldn't pay what they had out there if they're a gambling house. The government requires you to say, okay.
Yeah, your reserves that you're holding back, yeah.
Right? We have to take that money and we have to put it away because we got to be able to cover all our bets that are out there. If everybody at one time had a claim, we got to have enough assets to pay them all. That's what the government requires of insurance companies. And so now we don't just leave those in a piggy bank somewhere. They invest those to try to make money off that profit, and that's how insurance companies
make their money.
Right. And so, but that's how big the company is that I work for. And, they're constantly looking at that. And they're looking at, do we continue to write beach and, homes on beaches, right? When we know that probability, some of these homes are not going to be here every so many years. And what does that look like? That's why you see insurance companies getting off of coastal properties now. And the government's having to step in because, one, you got constituents that are down there and folks to represent those areas are like, hey, we want our beach house.
When they pay their $14 million for their beach house and they want...
Correct. Right? And so you'll see the government come in and have to set up some insurance for those folks.
So when you look at when you talk about your business model being conservative and having it solvent, you want to be with a you mentioned discount or internet based or
right.
whatever, insurance companies that use somebody else's name ish. When you look at those, does the government back up these insurance companies where they'll come in if they go insolvent? Or is it really, hey, look, buyer beware. You have to remember who you're doing business with.
That is absolutely correct. It is. You need, there's rating companies, financial rating companies out there, Moody's, some of the others that rate insurance companies like they rate banks. We went through this whole process of banks were too big to fail. When you looked at the really big banks and what happened, and you understand that process of how we got into that whole bank bailout, if you really look at that, we were writing mortgages. Fannie Mae and Freddie Mac were writing mortgages that weren't verified, right? Your income wasn't verified. So you had people out there because everybody's got to have a house, right?
Oh, that was the political nature of a home ownership, and that was how they were rating people. Oh, yeah.
Right, but it was non-verified income.
Yeah.
Right? It was stated income only. So I could say, hey, I'm making $20,000 a month.
Bryce, I remember getting a mortgage, and one of the guys who used to work for me called me and he goes, hey, I heard you're buying a house. I go, yeah. He goes, I can get you 125% loan with an extra $25,000 as a HELOC, no docs,
right.
Adjustable rate. And I'm like going, no.
I'm a 30-year fixed guy.
I'm a 20% down, 30-year fixed guy.
Yeah, right.
I am not. But you're right. You had so many of these just crazy things out there.
And that's what happened. And honestly, that's what's going to happen to us on Medicaid. Why our roles in switching hats in Virginia, Medicaid is our largest budget expense besides education, and it's growing. I think somebody said, don't quote me, 1,300% or something like that, because we can't keep up with it because we weren't verifying if somebody's really indigent or they're just sucking up resources, right? And that's a challenge for us. And I think we should have some verification that happens to make sure you're not working under the table and getting paid cash, right? And then drawing benefits as well.
Or you don't have an employer who's just going to sit there and go,
right. No say.
Yeah,
right?
yeah, I got nothing on that. Yeah.
And so, it's funny how everything's kind of tied together. And with insurance, back to your point, you want to make sure you're buying a product from a company that's going to be there later. And I'll equate it to this. There are a lot of competition around you right here.
Oh, there's quite a bit.
Right? But I know when I buy a car here at Pohanka, because you're third or fourth generation.
We're actually 101 years old.
Right, exactly. So. You're going to be around because I know your son, Timmy.
Yep.
And, you're going to be here. So Pohanka will be here, barring you don't sell to another family or somebody buys you eventually out and everything else. And so that's the stability you want, right? Because when I'm buying a car, I'm going to keep it for 10 years probably. I'm not, maybe unless something came by that Nissan came out with a new 390 or something.
400Z was announced yesterday.
Oh, was it really?
Yeah, 400Z.
Oh, maybe. Okay,
Yeah.
maybe I won't keep my other car that long, right? But yeah, I'm going to want to bring it here, and I'm going to want to have the service done, and I'm going to have that. So that's why it's important you buy from somebody that has a great reputation of being financially solvent, that goes to adds that value-added service, right? What is that value-added service, and what's that worth to you? Do you want the cheapest just to get by because, that's all you worry about? Or do you want to know that if something were to happen, that company, whatever it is going to do the right thing and take care of you? And I think that's where most people are.
So it wouldn't be right to not talk to a State Farm agent and ask this final question. Patrick Mahomes or Aaron Rodgers?
No, Aaron Rodgers.
Aaron Rodgers.
I don't know. Patrick Mahomes is like, he's a second baseman that can throw a football like I've never seen anybody throw like that. Right?
Okay.
But Rodgers is just like the quintessential, like, skinny quarterback. Like, you're like, how does this guy even function? Like, Mahomes looks like an athlete.
Oh, he's
right?
he's a talent.
I mean, a guy can throw 60 yards, flipping it on the side, right?
Yeah.
I don't know. I like Mahomes. He's got a great attitude. It'll be interesting to see what happens with the Chiefs. I wish football would change the way they pay their players too. They need to be like basketball and baseball, right? Instead of saying, I'm going to give you $54 million, really all you're getting is $1 million. And you look at the tendencies for injuries in football versus some of the other sports, it's ridiculous. But I'm just glad they're playing football.
I'm glad they are too. It was great to see. But again, you're an agent, so we got to
So
ask.
have you been to your new the baseball stadium and gotten in your box that you guys have?
We have not been out to this. We've been out to the stadium.
Right.
But if anyone has not been out to the stadium, they have to do a tour. It's absolutely incredible. We're actually going to be there this week selling cars. So
that's awesome.
Yeah, we have an event out there.
I mean next week, not this week.
Well, it starts next week. I will say,
it'll be sunny next week.
They are going to be a great addition to the town. The stuff that they've got planned out there, they're doing their best to try to be part of the community right now.
Well, the fireworks were incredible.
Yeah, the fireworks. They're doing movie nights. They're doing live broadcasts. The fact that the Nationals came down and used the facility for their training during COVID. They're using it right now. Says a lot about the facility that they put in. We're lucky. We're very lucky to have partnered as a dealership group with the Fredericksburg Nationals, but I think Fredericksburg is lucky to have had brought in a.
Well, I know
team.
you're excited about it because you're a sports guy.
I'm excited because I'm a sports guy, but I'm just excited because it's another great thing for Fredericksburg.
Right.
And, there's a lot of things we've had recently that haven't been fun for Fredericksburg, so it's nice to know that we've got something waiting. I really appreciate you coming in and talking to us about it. I'd like to have you back to talk more about financial literacy down the road, because I am of all the things that I think that this country and our kids need, they really need to know early on how financial literacy affects their future.
And a lot of your employees would have probably liked to understand, right? Because they're working hand to mouth, right? They're 30 days from the street. Many folks are working.
It's funny you bring that up. With COVID, we talked. One of the big conversations I had with our employees was the opportunities that are out there for them on daycare.
Right.
Because for a lot of them that are single parents.
Oh, now they got to try to educate their kids at the same time.
And you've got that. You've got two parents that are both working, and both of those jobs are important to keeping the family together. We actually had to sit down and talk to them about what options are available for them if they needed it or what they can do.
Isn't it amazing what you have to do as an employer now? Like your hats that you have to wear?
It's to say it's a responsibility that we have. I mean, someone asked me what the most important job I have every day, and the most important job I have every day is to make sure that people who work for us get paid. Right. And that they're taken care of in that regard. They don't have to like me. They don't have to send me a Christmas card, but they have to know that their check is going to be there every day. And that is part of what we have to do. But knowing that there's so many things that you have to help navigate them through, I do.
I don't have as many as employees, but I do know. Yeah,
we have 80. We got 1,600 in the whole company, 88 just here. It's definitely a give and take and try to work those things out. But thank you, and I'm serious. We need to have you back to talk about financial literacy.
Anytime.
I'd like to get you in a roundtable with a few other people talking about it, because especially in the schools, learning this stuff early makes a difference.
Well, a few years ago we passed a bill. Senator Peterson, I think, had it that talked about having some form of financial literacy during high school years, right? What's a checkbook? How's that work? And now you really start looking at like all the abilities to, whether that be Bitcoin or different ways to pay, and all the apps you can send money on, and these virtual banks and all that sort of stuff. But the fundamental principles of saving for the future, and how do you do that under what devices, like an IRA, which is, I call it just a cellophane wrapper. You can, that's deferring taxes basically till 70 and a half. You can do it through traditional, you can do it through a Roth, you can do it through a money market. There's different ways. That's just telling the IRS, don't tax me because I'm putting this money away. But, people need to start planning now. And if you really look at time value of money, the sooner you start saving,
oh yeah,
and this and I know this, we just didn't do it, right? But the sooner you started saving, you could already retire now, right?
Yeah, I remember my great uncle who just passed away. When I graduated from high school, he sat down. And he said, "Look, here's a book, and I still have it. It actually is a photocopy of a book, and it talks about how to save money. And he said every month, 10% of your check, no matter what you own or what you have to do,
right,
has to get put away. That is your first bill that has to get paid." And that was my introduction to financial literacy, but I took it to heart, and that's what I did. And those things are important. And getting the kids to understand is important. I talked about this in another podcast. When I worked in our Capitol Heights, our PG store,
right,
I can look at bad. There's a lot of poor credit up there, and when I looked at it, you can always track it back to $300. If you follow the logic and you follow the payments and the missed payments, where does it start? And it's over $300. It was either a prepaid credit card that went bad,
right,
or it was a cell phone bill. And you look at where that happened and what the impact is for them down the road. The financial ability for people in those situations that started over something so small, if it hadn't
just
happened,
compounds, yep,
is dramatic. I mean, you would be.
And then
open.
to dig out is even harder. You got to have a plan. Like,
Yeah.
what card do you pay off first? That's charging. You got to do the money. You got to do the math. Figure out what's costing you the most. Get rid of that one first, and then work your way back down.
Because and it's hard. It's very hard. I mean, and and it's sad because you look at car payments, a difference between a 2% rate and a 20% rate or a 10% rate, that's a lot of money.
But I think part of it on that topic is driven by the I want it now, right? Your kid, my kid, I want that now.
We want what we want, and
right,
and that's the other part that, again, when you look at people, going back to it, if you've got poor credit, and you've got a chance to get a $5,000 car that can get you credit experience reestablished at a higher rate versus, I want the $30,000 car at that higher rate. You pay on that $5,000 car at the higher rate for a couple of years, you trade that in, and then you get the more expensive car. Right. And we just have to try to get that through to help them, because if not, it's a never-ending cycle. So, and then again, it doesn't open up life insurance, understanding how that works,
right,
or anything that
get
goes
into the other products to help you realize that dream.
Correct.
Yeah.
So, thank you very much for joining us.
Thank you.
This has been a great Fredericksburg Strong episode. Thank you, Bryce Reeves, for joining us. We'll see you again. Thank you.
Thanks for listening to the Fredericksburg Strong podcast. Be sure to visit fredericksburgstrong.com to join the conversation, access the show notes, and discover our fantastic bonus content, as well as submit a request for you or your organization to appear on one of our future episodes. See you next time with another exciting episode of Fredericksburg Strong.